Welcome to the Deep Dive. Today we're jumping into the Q3 2025 earnings call for Reading International, or RDI. This is a really unique company.
It is. It's got this dual identity, right? On one hand, they're a global cinema operator, US, Australia, New Zealand. But on the other, they're a pretty significant real estate company.
And this quarter, it landed right in the middle of some serious headwinds for the whole cinema industry.
Exactly. The film slate was, to put it mildly, weak. So admissions were down, you had foreign exchange pressures. Management knew they couldn't control that. So their whole mission on this call was to prove their counter-narrative.
Which is all about asset sales and tight operational control.
Precisely. They wanted to show that even if ticket sales are soft, they have other levers to pull. The big question is, do the numbers actually back that story up?
Well, let's get right into it, because the top-line results, they were a mixed bag, to say the least. And they definitely confused people at first glance.
Yeah, the headline numbers were not pretty.
Global revenue came in at $52.2 million. That's a 13% drop year over year, and it missed the consensus by, about 11%? They were expecting closer to $59 million.
Well, a big miss. And the GAAP EPS followed right along with that. A loss of 18 cents, which was double the 9-cent loss analysts were expecting.
So if you just stopped there, you'd think, okay, weak film slate just crushed them. End of story.
But that is absolutely not the full picture. The narrative management was pushing was all about profitability control, and that's actually where they had a pretty dramatic beat.
Okay, so the market gets hung up on the revenue miss, but the real story is hiding in the margins. Let's talk about that EBITDA number.
Yes. Adjusted EBITDA was $3.6 million. That's up 26% from the same quarter last year.
And that's their fifth straight quarter of positive EBITDA.
Fifth straight quarter. And what's really fascinating is, while revenue is down, the net loss actually got better. It improved 41% to $4.2 million. That's their best Q3 result since 2019, before all the chaos.
So they're proving they can manage the bottom line even when the top line is out of their control.
It's just the tactical execution is mitigating those big structural problems.
And that tactical execution seems tied directly to their main strategy this year. Getting that balance sheet under control through asset sales.
It's the absolute core of what they're doing right now. Year to date, they've cut global debt by about 15%. It's down to $173 million.
And they did that by selling off properties like Wellington in New Zealand and Cannon Park in Australia.
Yep, monetizing what they call non-core real estate.
Okay, but here's the question I always have with this. Isn't that a dangerous trade-off? You're selling long-term real estate, which is where the hidden value is, just for short-term cash. Are they, burning the furniture to heat the house?
That is the critical tension here, and it's what investors are really wrestling with. It's a sophisticated strategy, but you're right, it has a cost. They're prioritizing liquidity right now because they have to.
So what's the trick?
The trick is they're selling the land but keeping the cinema. They sign long-term leases at these sites, so they get the cash infusion now. They lower their interest expense, which is a huge deal. It's down $2.6 million this quarter alone.
A 17% drop.
A 17% drop. So They stabilize the ship now, even if it means giving up some of that maximum real estate upside way down the road. They're buying time.
Buying time for the box office to come roaring back.
Exactly.
Okay, speaking of things they can control. Let's talk operations.
Yeah.
Because even with fewer people coming in, they're posting record numbers in the one place they can really make money. Food and beverage.
The KPIs on this were frankly outstanding. It gives them something to brag about no matter what Hollywood puts out. They hit a record Q3 for food and beverage spend per patron SPP everywhere.
What were the numbers?
In the US, it was $8.74. In Australia, AU $8.05. New Zealand, NZ $6.75. All records.
And I have to ask about this because they mentioned it on the call. They credited things like a spicy sauce flatbread and a Jurassic combo. There was even a Superman totem popcorn container. Is this real innovation or just a fancy way to charge more for popcorn?
It's both. And that's the genius of it. The flatbread, the combos, that's premiumization. You're creating higher priced themed items that feel special. And the Superman totem, that's just pure high margin gold. It proves they are mastering the art of getting every last dollar from every person person who walks in the door.
And it wasn't just about blockbusters either. They mentioned alternative content played a huge role in the U.S. this quarter.
A massive role. It delivered a record Q3 U.S. box office for them. They specifically called out a 2-day K-pop Demon Hunter sing-along event.
A sing-along event.
Yeah, and this kind of diversification is so important. It prefers them from the volatility of Hollywood. If a big movie flops, a niche K-pop event can still pack a theater and, more importantly, sell a lot of concessions.
Let's shift to the real estate they've actually held on to. The operating portfolio seems really stable, especially in the U.S.
It's the hidden backbone. Management talked a lot about cost discipline, like renegotiating with landlords in expensive places like Hawaii. But the real standout was New York City. The live theaters, Minetta Lane and Orpheum, had their best Q3 operating income since 2014.
Wow. And that's driven by successful shows like Mexodus and that long-term Audible deal, right?
That Audible extension is key. It's extended through March 2027. That provides incredible revenue visibility in a sector that has almost none.
It's a predictable income stream.
Exactly.
Yeah.
And internationally, their third-party tenant portfolio in Australia and New Zealand is still sitting at a super strong 98% occupancy. This is why RDI isn't just another cinema chain.
Let's look ahead then, because management is clearly betting everything on a massive film slate rebound to make all this hard work pay off.
Their enthusiasm was, you could feel it on the call. They're signaling a big Q4 holiday rebound. They even cited almost $850,000 in global pre-sales just for Wicked, for good.
That's a huge number, a great sign of pent-up demand.
And they went even further. They basically forecasted that 2026 could be one of the strongest box office years ever. They started listing off the tent poles.
Spider-Man, Brand New Day, Toy Story 5, the Super Mario Bros., Movie 2. I mean, that's a monster slate.
It is, but you have to ground that enthusiasm in the risks that are still there. I mean, how much weight can you really put on a film slate that's still, 15 months out? The real risk isn't the movies, it's the capital structure.
Okay, tell us more about that, specifically the debt refinancing.
They've got several big loans coming due in 2026. Bank of America, Santander, Valley National. Now, they successfully extended those maturities, which is good. It buys them time.
But it's really an admission that they can't refinance on good terms right now.
That's it. They're openly betting that commercial real estate markets and interest rates will look a lot better by the time these new deadlines hit. It's a gamble.
And the development pipeline isn't exactly helping with that uncertainty.
No. That big Noosa Cinema project in Australia, it's been pushed back again, now to around 2028. Management says it'll have great returns, but the delays just add to the market skepticism.
And then there's the elephant in the room, the huge legal battle over the viaduct property in Philadelphia.
This is a massive swing factor. The city of Philadelphia wants to condemn parts of it to build a public park.
So what's RDI's stance?
Management was very clear. They will fight it vigorously. And if condemnation does happen, they will seek the absolute maximum fair market value. This is not a small claims court issue. A payout here could be substantial.
So you have two wild outcomes. Either they keep a valuable long-term asset or they get a massive one-time cash injection.
Precisely. And that ties right into the other big question mark, 44 Union Square in New York. They have to get that leased. Management is still targeting a resolution by year end, but it's been dragging on, and it's a huge overhang for the stock.
Okay, so you add all this up. Tactical wins on costs and F&B, strategic debt reduction. But this huge uncertainty on the real estate side. How is the market processing all this? The stock is down, 18, 20% in the last year?
Yeah, it's badly underperforming the S&P and even other leisure stocks. The market is basically saying, we don't care about your 2026 movie slate dreams. They are discounting all of that cyclical upside because of the risk profile.
Yeah, execution risk.
The execution risk.
Yeah.
They see a highly leveraged small cap where these big, lumpy, complicated real estate deals, Union Square, the Viaduct, are everything. And they're totally uncertain.
So the core tension is that RDI is doing all the right things on the operational side, but the market can't look past the sheer complexity of their real estate situation.
That is the disconnect in a nutshell. Until they get clarity on how and when those cornerstone assets will be resolved, investors are just going to stay on the sidelines. They won't price in a box office boom until the balance sheet risk is gone.
All right, let's pivot to our final segment. This is where we pitch an outrageous but plausible trade idea based on everything we've just discussed. And a reminder, of course, this is not financial advice.
Given this massive discount the market is applying to RDI's hidden real estate value, I think the most compelling idea here is a long-short pair trade. We want to isolate that unique asset story from all the noise in the cinema industry.
Okay, lay it out for us. The pitch is long RDI, short a pure play, highly leveraged cinema competitor that has minimal real estate. Why that structure?
The short position is your hedge. If the whole cinema sector gets hit because the 2026 slate is a dud or the economy tanks, both stocks will likely fall. It protects your downside on the RDI long, but what it really does is let you make a pure bet on RDI's unique real estate optionality.
The thing that no other cinema chain really has.
Exactly.
So what's the specific catalyst? What unlocks the value in this trade and makes it work?
The catalyst is a resolution to one of those big real estate question marks. I'm talking either a signed, sealed, delivered long-term lease at 44 Union Square, which they're still hoping for by year-end, or, even more dramatically, a big favorable payout from the Philadelphia Viaduct condemnation. Either of those events unlocks a ton of non-operating capital. It would let them pay down debt way faster than the market expects.
And that would completely change the story. It shifts from struggling cinema chain to leverage turnaround with a huge real estate win. That's where you get the outperformance.
That's where you capture the alpha. It turns what the market sees as a risk into a massive liquidity event. And the pair trade means you profit from that specific RDI story, no matter how many tickets Toy Story 5 sells.
A really interesting way to isolate that value. Okay, to wrap up this deep dive, RDI is doing the right things tactically. They're controlling costs, they're killing it on F&B, and they're using asset sales to fix the balance sheet. But a skeptical market needs to see two things. That 2026 film slate has to deliver, and they need clarity on those big real estate projects, and they need it soon.
My final thought for you is to watch the interplay between their spending and their stability. Keep a very close eye on their ability to keep delivering positive adjusted EBITDA while also funding their big, high-return renovation plan for 2026. That will be the clearest sign they're on stable financial footing, completely separate from whatever happens at the box office.
Fantastic analysis. Thanks for joining us for this deep dive. We hope you feel better informed and ready for your next conversation. We'll catch you next time.